Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, and other important players in the industry who will help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and our Dakota Live content, please check out our website at dakota.com to learn more about our services. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or recommendation of the investment advisor or its supervised persons by Dakota. Today's episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediary database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakotamarketplace.com today. Well, I am thrilled to welcome to the show Alex Edelson, founder and general partner of Slipstream Investors, a venture capital fund of funds focused on investing in small pre-seed and seed stage venture capital strategies. Alex, thank you so much for being here. We appreciate you being in Philadelphia.
Thank you so much for having me.
Yeah, welcome to the studio.
Thank you. My first time in a studio.
Yeah, getting used to the lights.
Yeah, this is I feel like I'm in the big leagues here.
It's real. Yeah, we could either be talking about venture capital or calling a baseball game.
That's right.
So we've got options. Nick Butts from Dakota, thank you for joining us again on the show.
Great to be here.
Yeah,
Thanks for having me.
Thanks for being here. It's really a pleasure. I know we have a lot of questions to ask Alex. Before we do, we're going to read your background for the audience. Alex Edelson brings a unique blend of legal expertise, operational leadership, and investment acumen to the venture capital world. He founded Slipstream Investors in 2021, a venture capital fund of funds focused on small seed and pre-seed stage venture capital strategies. Slipstream also provides investors access to top-performing early-stage VC funds that are typically difficult to source or evaluate. Before launching Slipstream, Alex served as Chief Operating Officer, Chief Strategy Officer, and General Counsel at QED Investors, a leading fintech-focused venture capital firm managing over $4.3 billion in assets. He began his career as a federal law clerk for Judge Joel M. Flom on the U.S. Court of Appeals for the Seventh Circuit and has practiced law at prominent firms including Kellogg Hansen and Robbins Russell. Alex earned both his BA in economics and political science and his JD magna cum laude from the University of Michigan, where he was inducted into Phi Beta Kappa and served as a note editor for the Michigan Law Review. Alex, thank you so much for joining us here today. Congratulations on all your success and congratulations on launching Slipstream in the last couple of years.
Thank you so much.
So it sounds like when you were at QED, you were chief everything. So how were you able to narrow the scope at that point in your career?
It was an interesting role. It included being Nigel Morris's chief of staff, whose firm that was, who runs QED. And yeah, the role kind of evolved to like a broad operational role, working closely with him and then working closely with our operations team, our investment team. And then there was an external component too. So I don't think I successfully narrowed that role. It was a pretty broad role.
It sounds like it.
But it was a great opportunity for me to learn the business of venture and to learn how to run a venture firm. And yeah, I mean, I feel really fortunate to have had that experience. And frankly, I probably wouldn't have wanted it narrower because I got to be involved in so many aspects of it.
Yeah, that's wonderful. Well, you started your career in law, which is interesting, particularly in venture capital, and not uncommon to see owner-operators make their way into VC, but lawyers are a little bit different, but you found your way into it. So can you walk us through how that transition unfolded for you in terms of your career?
Yeah, it's sort of a circuitous story that doesn't make a lot of sense. Like the story is I was looking to get out of law for many years and then finally got out when I joined a friend's fintech startup. It was 2 years old at the time, roughly 2 years old. a very close friend. I joined the company, didn't work out as we hoped. And then I fortunately found my way to QED, starting as Nigel's chief of staff. And then my role kind of evolved from there. And while I was there, I saw an opportunity to start Slipstream and decided to leave QED at the end of 2020 and started Slipstream in 21. And yeah, it was based on a lot of learnings and observations I had at QED.
Why did you decide to go law in the first place?
My dad was a lawyer. My brother was going into law. I think there was like some inertia in that direction. Like, I think I believed at the time, and I still believe it's a door opening start to a career. It gave me really great perspective. It helped me. I mean, it's so trite to say like you learn how to think, but I do feel like I developed my ability to think analytically and critically and writing and reading and important skills. It also helps you like learn things quickly. Like you're constantly learning new sets of facts, new areas of law. That was really valuable. And I was drawn to like, I think the ability to like develop a real expertise and in something that is valued in society. I felt like there wasn't a limit on like what could happen after going to law school. Like there are a lot of things that lawyers do after going to law school or practicing for some period of time that you have some advantages with a legal background. And I am probably giving myself too much credit to say like I was thinking that far, but maybe at some point I was. I honestly just thought like I would enjoy it. And I thought I would enjoy practicing law based on what I knew about it. And I thought I would enjoy learning law. And yeah, I did figure out relatively quickly, like this is probably not the long-term fit.
Did you find your time at the University of Michigan? You did both your undergraduate and your law degrees there. Did you know at that point that was going to be the career path? I mean, obviously the law degree, but undergraduate, you knew that was going to be the direction. Did you get any exposure to finance or investments in undergraduate?
Econ and poli-sci undergrad, maybe I could make an argument about econ, but it would be pretty attenuated. So no, I don't think in undergrad I was really thinking about this or investing in general. Undergrad for me was more about like, can I develop the skill set and network in a perfect world that like can be helpful later on. Like poli-sci to me was more about reading and writing than it was about the subject matter. And like econ similarly was like about math and problem solving and thinking about certain types of problems, but it wasn't so much like, oh, I want to do this for the rest of my life.
If you met your younger self back at the University of Michigan, what advice would you give you then that you know now?
What I thought in undergrad was you get one shot. So like if you do undergrad or grad school at a high level, it creates opportunities for you down the road. And so I should make the most of this. Like if I do really well here, like no one will ever be able to take that away. And that can create opportunities for me down the road. And so I actually took it seriously. And I guess looking back, maybe I could have had a little more fun. But yeah, I felt like now's a unique time in my life and I should make the most of this from an academic and like network perspective. And so I spent time with students who were interested in things I was interested in. And I took school seriously, but this sounds pretty lame. Like it sounds like I wasn't a cool kid in college, which is sadly true.
It's okay. I was there too. I was not a cool kid as well. I studied history and I didn't think that I'd be going into investments. I had no exposure to investments. If you would have asked me, or if I would have been asked to give myself advice, it probably just would have been, do what makes you happy and figure it out from there. The opportunities will come up. But yeah, I think that's a very honest answer. So I appreciate that.
It is honest. Yeah.
Well, how is that legal lens then influence the way that you evaluate deals today? So when you think about conducting diligence and downside protection, particularly downside protection, how is that legal acumen and experience helped in those regards?
In diligence, I'd say maybe 3 ways most frequently. One is sometimes like I do a lot of reference work. A lot of my work evaluating managers is like, we're evaluating folks who have limited track records. And so you're doing a lot of reference work and testing for like sort of qualitative criteria. And so sometimes I feel like a little guilty because I am almost deposing people like in a friendly way, but I am kind of like walking them to where I want. And then we kind of get to the important stuff and it gets real. And I don't mean to sound like it's so strategic or calculating, but like it does, I do feel that side of my personality come out sometimes, like, oh, this is kind of how you want to build to this topic. And I do think it ends up getting real information, which is helpful. It happens when I'm comparing notes on a manager, and specifically like I'm talking to another LP and we all did references on a particular GP. And maybe we talked to some of the same founders or other folks, but we got very different feedback. That is really interesting to me. It is not uncommon. That happens to me all the time. And the most common way that happens is the person I'm talking to says, we talked to lots of founders and it was so positive. Like it was all positive. And I'll say like, man, I talked to like a lot of people too, and I got a lot of negative and like some recurring themes. And I sometimes wonder like what happened? Like how did that happen? And I think maybe this is part of that story, but I don't know. I'm not on their calls. I don't know who's doing them on their team. It's hard for me to know, but that is one impact. Another is like, at what point do you stop? Like in law, I think the way I thought about research was like you stop when you're no longer learning new things, when you feel like you have a sense for what's out there and you could read more cases, but you're not learning new things. And I have a similar approach now. Like I could do a zillion references, but like if I stop learning new things at some point, like this isn't a good use of my time. This is not respectful to the people who I'm asking for help from. Like this isn't really nice to the GP because I'm like, you know, utilizing their network's time. And so that principle is in my mind when it comes to diligence. Like I don't keep going when I'm no longer learning new things. Downside protection, it's really interesting. Like as a lawyer, you're like so focused on like, what are all the possible ways this could work out like negatively? And do we have answers in case any of these like risks materialize? Like we should be prepared for all of these things. And what I find is like, you end up focusing so much on the negative. What I do now is a little more fun for me, in that I think more about the positive, and I can be realistic about the negatives. Like, could we tighten up something in an LPA that is very unlikely to materialize? Sure, but like, is this a good use of anyone's time? Like, it's given me, if I could step back, I would say like, I am very comfortable with thinking through in a complete way, like the potential negative outcomes and figuring out which ones we actually need to address and which ones like we don't, and we shouldn't spend that much time worried about. But what I've learned over time and really enjoyed is like, no, let's focus on what we can build here. Like, well, let's focus on what can go right here. Let's focus on like, if this wins, why does this win? How does this win? How does this GP win? What do we think the odds are of that? Like, do they have increased odds of significantly outperforming? Like, sure, all of these funds have like plenty of ways they can fail. And that doesn't ultimately drive the outcomes for me, unless there's like such a massive issue that you're like, well, I don't take that risk. In law, you are constantly learning new areas of law, new facts. I was a general, mostly trial level commercial litigator. You're constantly learning new cases, new areas of law. And so you like sort of develop the skill set of learning new things quickly. And so every time we're meeting a fund, like you're learning their story, you're learning their sector, you're learning their portfolio, you're learning about their strategy. And that's actually helped me, sort of relevant to your last question, pick up venture quickly. I mean, I've been in venture since 2018, but like to really figure out like, how do I sink my claws into this and how do I learn this in a complete way so that like I understand the spectrum of issues that matter and we can sort of like go systematically and kind of develop expertise.
Speaking to a few early stage VC fund of funds manager in the past on this show, we hear a lot about pattern recognition. Do you think that your background allows you to recognize patterns in sectors, industries, or just some of those qualitative attributes that you mentioned, just the way that people speak, the language that they use, the words that they're putting forward?
Yes. I think what's interesting about pattern recognition, though, there are like two things that stand out to me about pattern recognition. One is it's very easy in venture to look at funds that have been successful historically and to say like, well, how are they doing it then? But like, what does it mean? How long does it take to know someone's successful? Let's say it takes 6 to 10 years. It's great to learn from them. And you want to learn from all of those success cases. But that was a long time ago. And the venture ecosystem has evolved. And the sectors they're investing in may have evolved. And so on one hand, I rely heavily on pattern recognition. On the other hand, I am constantly trying to be careful and about relying too much on pattern recognition because the venture ecosystem's evolving, and what worked 6 to 10 years ago may not be on the cutting edge now, may not be the best way to perform in this market. And so to me, it's like a data point, but I am constantly trying to figure out who's well positioned now for the market we're in today, for the strategy they're considering now in this fund. And so I try not to be like too overly reliant. Like I want to study it like anyone would study history, but like I don't want that to drive the decision making. The second thing though is, let's just take one sector, for example. Let's just take fintech. So QED is a fintech focused venture firm. So if I'm talking to a fintech focused emerging manager that we might invest in, I'm putting this in the context of all of the other fintech fund managers I know. It's in the context of all of the fintech founders that I've spoken to and their thoughts on what they're looking for from their VCs and how they interact with VCs and what caused them to choose a VC and the round dynamics that caused, someone to get some level of ownership or a deal to get done at a certain valuation. And so like there's a pattern recognition there too. And it's something that's constantly evolving and it's a little more current than some of those like historical pattern recognition data points where it's like, look, I've now talked to let's call it 10 or 30 or 50 fintech focused funds that I think are most promising. Like kind of what are the patterns I'm noticing here? What am I hearing from founders when I'm referencing them? And what does that say about sort of who's uniquely positioned to succeed going forward?
Well, in addition to spending time in traditional VC firms, you've also been part of startups. So when you think about those two environments, how did those two environments shape the way you think about specifically innovation and risk taking? And I think I'm a little bit more interested in risk taking. I think a lot of the allocators that tune in, particularly on the limited partner side, they have some VC exposure, but it's still new and still growing. And it's an asset class that I think that's starting to, that allocators are starting to spend more time with, particularly on the earlier stage. Yeah. So would love to hear how time in both those environments affected your views on risk taking.
QED is a wildly successful venture firm across many vintages. The evolution of venture ecosystem, you could argue like the evolution of fintech as like an appealing sector and venture. And the learning there was like people are doing a lot of real work and they are doing institutional grade work at a very high level. And there's a lot of things that you can do to mitigate and manage risk. But at the early stage of venture, like there is a messiness, there is an uncertainty, there is a level of risk that people are comfortable taking that was a big change for me coming out of law. Like I'm not saying things out loud I'm not like very sure about. And when I got out of law, it wasn't quite that way. And people are like making their best guesses, they're doing their best work, but they're dealing with uncertainty in ways that like I didn't deal with uncertainty before. I sort of learned like the process for what it takes to increase the odds of outperforming and the types of risks that go into that. And sometimes like the messiness that goes into that. Like it's not all what it sounds like in some beautiful fundraising deck or someone's 30-minute pitch to an LP. Like there's a reality to it that involves taking risks and sometimes like doing things that feel like maybe not institutional grade, but that's what it takes to win that deal, or you had to move particularly fast. And as an LP, I think if I hadn't experienced the GP side, I might be a little less comfortable taking certain risks, but maybe I would be more comfortable taking different risks. Like, let's give an example. Like, just working at QED where there is a team, I can see how one investor working largely alone for large periods of time can source, pick, basically win, and add significant value to companies. Now, we were doing that in the context of a team, but like you could pick out an individual investor there and have plenty of vignettes about like how amazing they were as an individual. And they were really the point of contact for that founder. And it's like, I don't know, maybe I would be less comfortable with a solo GP risk, for example, if I didn't see how much one person can do to like generate returns at the fund level.
It's an interesting example. Thank you for sharing that. So when you think about why you started Slipstream, what was the pain point that you were looking to solve for investors?
I think about it, it's like I saw an opportunity in venture and I thought I was uniquely situated to take advantage of that. And that led to me starting Slipstream. So it was more like opportunistic. Like, I think there's a great thing here. I think we have a unique perspective. I think we have a unique way of doing this, more than like, oh, there's a problem I'm trying to solve or a pain point I'm trying to address for someone. But yeah, the opportunity I saw was, look, we were growing at QED and I was realizing like, it's really hard to scale venture. Just to like get enough ownership relative to your fund size and get a high enough hit rate and to get big enough wins to like significantly outperform as fund sizes grow. It's hard. And I realized like there's so much opportunity in these small funds and they are very hard for people to evaluate. They often have limited track records. Once they have a track record, they often get larger. That may negatively impact their returns. And so I was realizing like, one, I think the opportunity is these small funds. Two, people really struggle to get to conviction on these small funds. There are thousands of these small funds. Like, it's hard to stay on top of them and make sure you're seeing the best funds. It's hard for some folks to like get enough capital into these funds. They're too big. So like the juice kind of isn't worth the squeeze for them. So they don't even try. And it's like, it felt like an almost overlooked part of the venture ecosystem, but it has the best upside for the people who know how to evaluate these funds and can stay in front of this ecosystem, or at least can see enough of them that they're like getting into that they're seeing the right ones and they can identify them as they come. Like, it felt like if I could do that, I mean, there's a great opportunity there. And so I was learning venture at QED, like kind of like under the hood at a really successful venture firm. And we were very introspective about our success and failure over, many successful funds. And we got a lot of founder feedback. So I was sort of getting a sense for like, what does it take to build a flywheel in a community of founders who are relevant to your strategy? Like, how do you get the next generation of founders to help keep you in front of, or the last generation of founders to keep you in front of like the next generation of great founders? And like, what do we do to like kind of increase the odds of outperforming from the perspective, or like on the topics of like sourcing, picking, winning, working with companies after we invest, getting our portfolio construction right, getting liquidity, not just passively. And so I was realizing like I have a framework for how to think about any venture fund at the early stage. And it's particularly interesting at this early stage because they don't have much of a track record, but I don't need much of a track record to test for some of these things. They need some investing experience. And I need to know like the VCs they've worked with, especially at the next stage. I need to know the founders they've worked with. And then you can kind of test for this qualitative criteria. And that made me feel like, wow, maybe I could do something here. And then one thing that was interesting was like, we were working with all these emerging managers in a variety of ways. And some of them we thought were great, like were not consensus in the LP community. And like, our beliefs about their quality or my beliefs about their quality just like didn't always correspond to their fundraising ability. And at first it's like sort of disorienting. And then I was looking around and feeling like, like most of these LPs who would be considering an investment into their funds, they didn't learn venture at a high performing venture firm like QED. They learned it in a different seat. And that doesn't mean they're not great LPs or they won't build great portfolios, but it maybe emboldened me a little bit to think like, maybe I have a unique perspective here. Maybe this is like an advantage that I could capitalize on in some way. And then I started building relationships with them and I would engage with them and help them when it came to things like portfolio construction or investor relations, or what information about your portfolio should you track over time that might be actionable in the future for you, or how to build a platform function on a limited budget. Some of the stuff is just tactical running your venture firm, like everyday work that people are doing. It's not the glamorous stuff. It doesn't always relate to returns. And I was realizing like, I'm kind of building a flywheel in this community. Like we talk about building one in the fintech founder community. and thinking like, maybe I can get into these funds. And some of them like were not capacity constrained. Some of them that were, I felt like I could probably get in. And so those were some of the bigger observations to me. It's like, this is a somewhat overlooked part of the asset class. Very hard for people to evaluate these folks. Maybe we know how to evaluate these folks. Maybe I have a different perspective. I think I'm adding value in ways that are unique to us. And I tell the story in a linear way, like it was all building naturally towards Slipstream. It was so inevitable that like, but it wasn't. Like, this is something I realized kind of over time. And I got to a point where I was like, yeah, I think there's an opportunity here. I don't know that I'm solving anyone's like problems, but it's an opportunity that I felt like I was uniquely positioned.
Well, I would think arguably early stage venture is not a large position in people's portfolios, like just from an asset allocation perspective, but the upside potential is significant, significantly more than other asset classes. So I would suspect that you are giving them something that is potentially missing. And because you're doing it through a fund of funds format, arguably, it's an argument that you're diversifying some risk because you are looking at more than one provider. So you're taking on some of that burden for them.
I'm sort of describing this as like I'm not really solving a pain point, because at the time, that's not how I was thinking about it. But at the moment, what's happening is for our LP base, yes, we're solving typically one of two common issues. One is people who know these are the highest performing venture funds, but they are not well positioned to get exposure to these on their own. And so they outsource that to us and they get diversified, but we're actually pretty concentrated exposure to these types of funds. And so I suppose if you want it and you can't get it on your own, then we're solving that for you. There are other groups who do some of this work on their own, or they want to do it on their own. And we are a strategic partner to them in helping them build out their venture portfolios.
No, that's great. And in a crowded field, what's really your edge? How are you positioning Slipstream to your LPs and the funds that you're talking to? What's your edge?
The way I think about this, and you phrased it kind of how I think about it, is like, what is my edge with GPs? What's my edge with our LP base or potential LPs? With GPs, yeah, it's so interesting. Like sometimes I get feedback like, you behave more like a GP than an LP. And I think that's because that's where I grew up in venture, like on the GP side. And how that ends up functioning for me is you're pushing on people, you're giving constructive feedback, maybe not asking the same sort of standard questions. We're going a little deeper on a few things that maybe I'm particularly interested in, or opportunities where I feel like maybe they can improve or maybe not, but like, we should have the conversation. Like one thing I heard while I was at QED was that like a VC's job is to help an early stage founder figure out like the biggest version of their potential idea. And I sometimes feel like that's my job. Like, someone comes with a strategy and maybe they're early in their process and I'm like, look, is that the best way? Like, would this way be better? Like, how'd you think about that? Well, what if this were true? What if it took you 2 years to know whether any company you invest in is likely to get to product market fit? How does that impact your reserve strategy? How does that impact your fund size? How does that impact your check size? So often the interactions that I have with folks are maybe different, with GPs are a little different than other LP conversations they have. And it's also in part informed by the experience at QED. And like, what does a great LP look like? What does a good LP look like? What does an LP look like who kind of bothers the GP? Like, could I be a good LP? Could I be a great LP? And sort of thinking about the way they spoke to us and interacted with us and the ways they added value and behaved, that's in my mind when I'm working with GPs. And so also with GPs, like I think you build a reputation over time and they talk to each other about LPs. And so my hope is that, yeah, like we have a reputation of maybe being a little more helpful and constructive in the early days. It could be like operational things, like I'm talking to them about how they're running their firm. We're helping edit job descriptions when they're building their team. We're talking about edge cases. We're talking about like, is this a time when maybe I should flex on ownership or entry valuation? Or they're really excited about a company. Should we follow on? Should we do an SPV? Should we cross-fund invest? Like, these are things that I saw and had data on over long periods of time at QED and that I see a lot now. And so one thing that's really important to me is like engaging with GPs in a constructive way, both before and after we invest. And sometimes it's just fundraising, like, hey, I know LPs who I think would be a fit for you. You should meet them, or I can reach out to them for you, and trying to help there. But like building a reputation for adding value in unique ways that like other LPs don't or can't or just don't often do. And with potential LPs, yeah, like I think a few things distinguish us. One, like unique experience at QED, learning from the GP side. And like I mentioned before, like I just thought there weren't a lot of LPs that had the experience of learning venture at like a really successful venture firm. And I think that just helped me get a better sense for what to look for when investing in funds, like the types of things that matter when it comes to like increasing a fund's odds of outperforming, with the network that you build over time through that, and how that impacts your ability to work with these funds, like to help them and challenge them, which ultimately like helps us get allocations in funds. So that was the first thing, like unique experience at QED. The second is, how that impacts our ability to add value to the GPs and win allocations, like I mentioned. And the last thing is like, we are small by design. It is a unique edge for us. It makes it easier for us to get into small funds, oversubscribed funds. It makes it easier for us to be concentrated in our portfolio. We are more concentrated than most other folks who have a similar strategy. It helps us leave room for our LPs to come into these funds as well, as we are not taking like all of the available capacity. And it also helps position us with other folks in the industry. Like, we shouldn't be the reason why other people can't get into these funds. We might be the reason they find out or get to conviction or avoid one of them. It's helped our positioning in the ecosystem generally, which then helps us see more and helps us get into more. And it's a virtuous cycle.
Alex, when you talked about giving advice, being a partner, working very closely with the GPs, it sounds very close to GP staking and GP seeding businesses. I know there aren't a lot that do it in VC, but why not go that extra step? Why not take stakes in these businesses rather than just operate as a fund of funds?
No, it's a really good question. And people are doing it. And I think like it would look good in a deck. One thing I worry about is adverse selection. Like, are the best funds going to be comfortable with that arrangement? And let's say I do it selectively, but then people know I'm doing it. Will the best funds want to talk to me if they know that that's what I'm doing with other funds, even if I'm not going to do it with them? Like, what I want to be known for is like full alignment with GPs, and I am on their team. I want them to succeed financially when their funds do well. I want to also. And so what's like the bottom line for me? I want to be in the best funds. And if I'm in the best funds, like the economics work. And so my mission is like increase my chances of being in the best funds.
So when you're sourcing new managers beyond, sector or stage diversification, how do you think about building a portfolio that balances that different decision-making styles or behavioral styles among managers?
I'm not sure I think about diversifying across decision-making styles or behavioral styles. I think about diversification across time and sectors and geography and companies. If I were to go a layer deeper and maybe be more direct on the question is, we are typically drawn to funds, to GPs who are independent decision makers, who are not looking for social signal or social proof from other venture firms, other investors. Like, they'll be the only VCs in the round. They'll be the first to put a term sheet in, even if they're not like taking sort of what you would typically consider like lead level ownership. They'll just put a term sheet down and they'll do it on their own. That is very appealing to me, especially in like a really crowded market where one of the big challenges is like, can you get there at or before inception or very early, like before other VCs are there ideally? And if so, can you get to conviction before they get there, and this round potentially gets out of your reach in terms of valuation or ownership.
One of the things I'm interested in is when you're thinking about early stage VC due diligence and operational excellence, arguably a lot of these managers are building the bike while riding it. So how do you evaluate kind of operational infrastructure as you are trying to, build an investment case?
Yes, it does probably look different than folks who are evaluating managers who are significantly larger, bigger teams, have bigger budgets for these sorts of things. Like there are certain third parties that are kind of like easy to diligence, right? It's like, do you have reputable groups doing your fund admin, legal, accounting? Are there any sort of like obvious vulnerabilities in like your tech stack?
Mm-hmm.
Are you tracking the sort of standard information that I would think you should be?
Mm-hmm.
Like from a cybersecurity standpoint, like do you have this sort of basic important stuff in place? But yeah, you're right. Like these are such nascent firms. Like they are not typically so built out at this stage that there is a robust operational due diligence like that I can manage relatively quickly. There's just not that much to diligence, and there are some industry standard things that you're looking for. And if they have them, then for the most part, you are good. Now, like on the LPA front, like sometimes that can be a little more involved because surprisingly, there is still a broad range of LPAs for emerging managers. And hopefully over time, we will move towards more of a consensus terms in LPAs for emerging managers. But right now, that is probably where, I do spend plenty of time there making sure like the LPA is in good shape.
Speaking of where you're spending your time, are there any areas of the market that you're spending time on today in terms of filling a need as part of the fund?
We are a generalist fund. So like our strategy includes investing in generalist funds and sector-focused funds. We don't do all sectors. Like the sectors where we're mostly focused when we're looking at sector-focused funds would be like enterprise infrastructure, fintech, healthcare, deep tech, and supply chain logistics, industrials, manufacturing. We have some exposure there. And then we get exposure to other categories through generalists, and we get exposure to those categories through generalists. So like AI and all this, that AI is sort of in everything. I almost don't view that as a category at the moment, but that's how we think about it. So to the extent we're looking for exposure to a particular sector, it's only because we would like to have, let's say, an enterprise infrastructure fund in every fund of ours. We'd like to have a fintech fund, one fund, let's say. So if we don't have one in a given fund, then we'd be looking for one. And then geographically, like we're mostly US, we do a little in Europe and Israel. And so if we don't have exposure there in a given fund of ours, like we would be focused on that.
And in terms of criteria, fund 1 through fund 3?
As a matter of fact, we are almost always first 3 funds.
Mm-hmm.
But we're open to anything. We recently did a fund that's a fund 5. So it doesn't need to be funds 1 through 3. It's more of the emphasis is on, like the emphasis is mostly on small funds. It's like small funds with portfolio construction so that they can like significantly outperform and sort of justify the risk and illiquidity in the asset class. So like one thing you mentioned earlier that we didn't go into deeply, but it made me think like, as people think about venture, like what justifies the risk and the illiquidity that we're all accepting in this asset class? And to me, like the answer is like the funds that can significantly outperform all the other asset classes. Like if you can't, then what are you doing? What are you doing in venture? And so, we're focused on funds that have the portfolio construction and size to be able to significantly outperform if they get into great companies.
And when you're thinking about those GPs and exits, just thinking about the secondary market, M&A, how do you see your GPs thinking about exit strategies today relative to a few years ago?
Let's distinguish the GPs we've invested in from GPs in the market generally. GPs in the market generally, one thing I'm seeing is like a lot of interest in getting some DPI, like sell something and be able to show that you have gotten liquidity. The challenge is it's not always an amount of liquidity that is relevant to fund level returns. So someone will say, hey, look, we have DPI. We're in the top whatever quartile, decile of DPI for our vintage, it came from something that maybe like wasn't a big success, or maybe they were selling a part of a company that could be really successful, and maybe they returned like 0.2 or 0.3x DPI on their fund. It's like, guys, we've got to play for outperformance here. So like sometimes I ask a GP where they're like really celebrating DPI in a deck or in a pitch, I'll say like, if you had known at the time you made this investment, like this was going to be the outcome, would you have made this investment? And often the answer is no, because it wasn't a venture scale outcome. Now it did generate DPI, and because so few funds have DPI early in their evolution, they are looking good early on in terms of DPI relative to the asset class. So maybe they can say like we're in the top quartile or top decile, but it's not actually helping them get to venture scale returns. My hope is that our funds are close enough to every company that they are thinking about whether they're a buyer or seller, like at least like on a regular basis, say every 6 to 12 months, and certainly like when a company's fundraising. And if they are a seller or a buyer, they think about whether they should take some action based on that. Like if you're a seller, should you consider selling in secondary, selling into this round or selling in a secondary transaction? If you're a buyer, should you consider following on or doing an SPV? That doesn't mean they always should do anything. Maybe the right answer is to do nothing. But my hope is that people are thinking about it on a regular basis and taking action when they can, when it's appropriate, and when it doesn't sort of limit their ability to generate meaningful fund level returns. Like don't just get DPI to get DPI, get it in a way that's consistent with generating outsized fund level returns. But yes, there's much more emphasis on it now. And I think in 21, in like the 2020 to 22 period, what I would hear from people, which kind of, it made me sad a little bit, was people seeing companies that were growing fast, raising quickly, having very fast markups, saying things like, this could be $100 billion company. Like, and I'm thinking, yeah, like it could. Like the chance is not zero, but it is so unlikely. Like we're talking about a company that is valued at like $1 billion right now or $2 billion right now. This could return I had a conversation with the GP. This could have returned their fund multiple times to sell at a few $1 billion entry valuation or at a few $1 billion valuation. And they didn't sell. And because the view at that time among some folks was like, it can get so much bigger, and it can get so much bigger. There's always the chance it keeps growing. But I think some of those folks are a little more conservative now. I think GPs are a little more conservative and they're thinking about like when to start taking money off. So I see certainly more focus on it and more interest in being active around getting liquidity instead of just like passively seeing how big this thing can get.
Let's talk about reserves. How do you think about reserve strategy in terms of how funds manage them?
Yeah, it's a good question. It's funny. I feel like there has been an evolution here, and there was a time when there was an argument when a lot of people were arguing for a lot of reserves, and now it feels like I'm increasingly talking to folks who say like, well, I know it's better for returns if I have less reserves. And yeah, my trend is towards less reserves, but like, here's how I think about it. Like there are a few levers you can pull when you're thinking about reserves. You can have reserves. You can have more initial investments. You can have bigger initial investments. You can have a smaller fund. So when it comes to like returns, having more reserves is only good if you're getting them into great companies. Otherwise, you'd rather have anything else. More ownership in other companies in the portfolio, smaller fund, or more shots on goal. Yep. So then the question is like, well, okay, like how often are people making the right decision about which companies to follow on into? Mm-hmm. And so then you're sort of asking, well, like how long does it take for someone to like be right about whether a company they've invested in is going to be a successful company or has significantly increased odds of being a successful company? And yeah, like I think reserves are tough because my observation from talking to folks at the earliest stage is that typically people don't really know whether they've got like a real company that's going to like get to product market fit and have a chance to generate like meaningful fund level returns in less than 2 years after making an investment. Like usually you need at least that period of time. Like at least 2 years. And so often the decision about whether to follow on into a company will come before that. Sometimes it will come before you've finished making initial investments out of the fund. So you don't even know all the companies that are going to be in this fund. And so it becomes really hard. I mean, if you take that as true, which is not always true, some people have demonstrated success with a fast follow strategy, following on quickly in between rounds. Some people have demonstrated success using reserves, just following on to the right companies the next round. Some people preempt rounds. They've done that really successfully. So I don't mean to make like a blanket statement, but as a general matter, I want fewer reserves because it's so hard to get them right. And in most cases, like they're not all going to the best companies in a given fund.
Yep.
There is a relevance here to winning and to helping companies get to a point where they're like generating meaningful fund level returns. So like think about if you're trying to lead a round and you're competing with other firms and the founder cares about your ability to support them in a time of need, to invest with them along their journey, to be a positive signal for them, for other investors. If you have no reserves, especially in a market like now where it's taking longer to raise an A, the bar is being raised to raise an A. If you don't have reserves to help your companies get to that point, it might be harder on the front end to win those deals. So like you might risk adverse selection if you don't have some reserves. Now, for the smaller funds who are not leading rounds, they are less likely, it's less likely that a founder will rely on them to support them in a time of need. They don't have enough capital. They're small investors in the round, let's say. And so maybe less important from a winning perspective for a non-lead investor to have reserves. But there is a non-trivial role that like reserves play in winning, I think. And especially in this market, like having significant reserves can help your companies survive long enough to get to an A or to get to like the next round. And so maybe companies that could be great, but were supported by VCs who couldn't keep investing, didn't have enough time, they ran out of capital, they didn't reach a great outcome. Whereas like some of the best companies in venture were not the fastest growers out of the gate. They needed a little extra time. And if you can help your company last a little longer, like that actually could increase your odds of success. So I don't mean to say reserves are always bad. And they're certainly amazing when you get them in the right companies. But as a general matter, the way I think about this is like funds that are leading rounds are going to they should have reserves. Mm-hmm. What amount that looks like, it's a bit case by case, but like, let's call it 30 to 40, maybe 50%. And I'm comfortable with a little less too, but not a ton less. Funds that are like, let's call it, targeting 4 to 6% ownership. Maybe these are 20 to 30, $35 million funds. Maybe those have like 10 to 20% reserves. Then the really small funds, like let's call those like sub $15 million funds, like as a general matter, no reserves. And some of these folks like could be 20, 25, $30 million fund, have no reserves. That can be an excellent strategy. So these aren't like these aren't rigid rules,
right?
But like as a general matter, that's kind of how I think about reserves, but it's a case by case basis. And as the ecosystem evolves, like thinking on this should change.
Yeah.
Hearing you talk, Alex, I can't help but think how many pitches you've heard in the last few years. Managers coming in, GPs coming in, pitching their strategies. When you think about what makes a memorable presentation, what makes a memorable pitch, what are some of the attributes of those presentations that really stand out to you?
So to me, there are sort of like two threshold questions. One is like, is there good reason to believe like you're going to be in great companies? And two, like, do you have a portfolio construction so this fund can significantly outperform if you're in the right companies? Mm-hmm. And so the second topic, the portfolio construction topic, is like a little simpler. So like that could stand out if there's very unique portfolio construction, but typically we're looking for certain things. And the first topic is where like maybe more of the action is on like things that could stand out. So like what I'm typically thinking about is like sustainable competitive advantages mm-hmm. that are related to sourcing, picking, and winning, which is also related to how you engage with companies and add value after investing. Mm-hmm. What really stands out to me on the sourcing front, for example, would be like, are these people in front of high quality founders at or before inception. Like that stands out. That's hard to do. Are they getting there before other VCs? It's so hard in a crowded market with a ton of VCs and a ton of founders. And like if you're the only one there, you're really early and you're investing at very low entry valuations on your own, for example, there's no other VC around. That's really interesting. From a picking perspective, what stands out is like people who have their own independent investment judgment. They're not looking for social proof. They're not necessarily waiting for a lead. I mean, sometimes you have no choice, but there are people who are making their own decisions. And often those are like not consensus. And they are in the minority of folks who are interested, who are making that deal, or maybe the only one. And then like it goes on to like show some traction, to show some promise. Often like I'm talking to these folks so early that like that company has not like fully reached its peak, but there are indications that that was a good investment, despite the fact that like there was not consensus at the time they made it. From like an adding value and winning perspective, it's like some unique domain expertise or operating experience. Like QED is like a great example of this. Like QED is one of the two founders of Capital One. Like in 2007 or 8, like when QED is getting started, if you're a fintech founder, who has more relevant domain experience, domain expertise or operating experience than someone who founded Capital One and like people on that team? So like if you're a fintech founder from a sourcing perspective, like you got to talk to those guys. From a picking perspective, like they should have a really unique advantage. They know what it takes to succeed in this industry. They know common issues. Like they've seen a million folks try and fail. They know what customers are looking for. They should be able to win and add value because like, look, these guys can help you get customers, solve these problems that are common issues, like overcome the most common sort of startup issues they've seen create issues for other companies. Their level of operating experience and domain expertise is just so unique that like they had a sustainable competitive advantage. There's no other VC at the time doing fintech investing who has experience relevant to fintech founders like theirs. But it's only they sustain it if they're great to founders over time, and the things that you would believe about them, that they can add that value and that the founders will love them. Like they need to do that over time. They need to make founders love them. They need to add that value. They need to be great partners for founders. And then like that flywheel gets built. And so like, I'm looking for folks who like, if they do a good job of executing on that strategy, will have a sustainable competitive advantage relating to like sourcing, picking, winning, adding value.
Thank you for all of your thoughtful insights today. We greatly appreciate it. We appreciate you being here in Philadelphia during what sounds like a storm. So I'm not sure if that's going to get picked up in the audio for our audience, but if so, the flash flood warnings did go off. But we appreciate all the insights that you gave us. Congratulations on Slipstream. We wish you nothing but future success.
Thank you so much for having me. This was a lot of fun.
Thank you for being here. Nick, as always, thank you for being here on the desk.
Pleasure. Thanks for having me. It's great to see you.
If you're interested in learning more about Alex and Slipstream Investors, please visit their website at slipstreaminvestors.com. You can find this episode and past episodes on Spotify, Apple, or your favorite podcast platform. We're also available on YouTube if you prefer to watch while you listen. And if you'd like to catch up on previous conversations, please be sure to visit our website at dakota.com. Alex, thank you again for joining with us. Nick, as always. And to our audience, thank you for investing your time in Dakota.
Don't say goodbye.